All right, it is time now for past picks. The first one up is Wells Fargo, WFC. So let's talk about this one. This was a year ago. Big change as to what's been going on there. What's your take?
Yeah. So keeping in mind, we are active managers. We really like the U.S. banks. Along the way, we thankfully exited the Wells Fargo. In simple terms, we like to see companies with fundamental characteristics that point to things getting better and prices doing what they should be doing, given what you think which clearly, Wells Fargo has not been doing. Our big weights now would be JP Morgan and Bank of America. I wouldn't invest in Wells Fargo right now. We're not value investors trying to pick bottoms in things. I think that they've got obviously some issues that they've got to get through. But I think the U.S. banks are very attractive. It is one group that does well in the event of rising rates. And I really think we have seen the top in the bond market and that we want to have exposure to financials right now.
David, when did you sell Wells Fargo and why?
So, you sell things sometimes fundamentally and you sell things sometimes technically. If you keep in mind where we were a year ago, this was coming into November, December, January, which were very weak. The S&P 500 sold off about 14% in that period. And in that period, we wound up with a lot of cash. We got stopped out of a lot of positions. So we would have been stopped out in early January last year, and it would have been at levels around $62, $63 a share.
Okay. All right.
So when you get a big sell-off, we don't stay invested the whole way through. We do make an exit and wait for a better opportunity, and then we will never buy a security once it's falling in price. So if it's making lower lows and lower highs, it just doesn't qualify for our strategy.
Okay. Let's take a look at HCA Holdings as well. This was another past pick. How's this? Let's see how this one has done. It's down a bit as well. Yeah.
So HCA has been dead quiet over the course of the last year. It had a lift through November, December, January, February, and then basically has consolidated ever since. It's interesting. This group actually is starting to look quite interesting. We have some United Healthcare also in the portfolio. A quiet stock is not a stock you have to sell. It's okay for companies to consolidate their gains. And so I think that as we move forward, as we get through the election, things will become clearer. It's becoming clearer that the Democrats have more likelihood of success. That's good for managed healthcare companies ultimately. So we think that this group can probably catch a bid. The sector has been improving from a relative strength standpoint since June. And in fact, we're basically at new relative strength highs versus the market for the year for the hospital services group.
Okay, would you be buying more now?
I think you can buy it right in here. We're trading basically near the highs for the year, which were in April. If you take out those highs, you get another leg higher.
Okay, let's take a look at the next one. It's Fiserv.
Fiserv is a company we've held. It's doing remarkably well. I talked about it earlier in the show. It's financial technology. It's pulled back a little bit, about 10% off the highs, and which is just fine. Companies pull back in price as long as they don't break long-term trend. Fundamentally, the stock is performing really well. The earnings are growing nicely, and they have growing market share.
What's the biggest risk to it, do you think?
Well, if the bank's businesses really get difficult, then they're going to have to start cutting back spending. I think it's highly unlikely because this is an area that can help them build productivity. Many of the banks have said we're not going to depend on higher interest rates to make a bigger net interest margin.
Right.
We're going to become more efficient. So, JP Morgan's a great example of that, and Bank of America is a great example of that. So I think that the big risk is if you really thought there was a financial problem, but if you look at the credit default swaps for financial services companies, they're completely benign. There doesn't look like there's any major problem.
How does this company, if we can bring it up again, just maybe even over looking at this chart over the past month, as there's been more views or a growing view that Clinton would win? I'm just wondering because everybody knows that she's going to be pretty tough on the banks and banking regulation. How does this company perform when that gets heated up? So
relative price performance over the last 2 months relative to the S&P has been dead flat. Okay. If you take a look at the large bank group, you could put up the ETF for KBE. It's basically seen rising relative price performance versus the market. If you put up IAI, which is the investment banks and asset managers, same thing, relative price performance is improving. So the whole financials group is improving. Now, on one side, people have concerns about regulation. On the other side, I would say the bigger issue is we're come off 1,000-year lows in interest rates, and you're starting to see around the world sovereign debt yields rise. Well, that's a good thing for financials. And so I think people in general are underweight financials.
Yeah.
And I think that you're seeing them start to rebuild positions.
Okay, we're going to be back after this short break. Our number is 1-855-326-6266.